What's going on, everyone? Welcome back to our investor series. Lordis, good to have you on. Today, we're going to be talking about a very important subject, which is going to be risk management and having an exit strategy with your investment properties. Now, this is also going to apply to a certain degree if you are a homeowner. And why it's important to understand this stuff is because when you are thinking about buying, you should be also understanding what the sell process is going to look like so you can manage that risk. So, Lordis is a realtor. She's an expert within the real estate space, also a veteran and an investor. My side is on the loan officer side. So, if you need help getting a loan, no matter what type of loan it is, happy to help you out. In the description down below, you can schedule a call with me. So, Lourdes, let's start with risk management and talking about what risks are involved with investment properties and how you could position yourself to limit risk.
Yeah, so this is very important, especially like how you hit on when you're looking to purchase a property, you also want to look at the exit strategy. Is it an area where, the rents are super high and your cost is very low? Would it be a good cash flowing property? If you are, for example, moving from somewhere else, do you have enough entitlement on your VA loan to purchase another property, etc.? So, one of the first things that I do want to talk about is making sure that you do one have the proper insurance, and I know that's something that you want to also like revisit is every year, because if you start to see an increase in your mortgage and you're like, hey, my taxes didn't go up, why is my payment so high? I would definitely look at the insurance and just make sure that there wasn't a significant increase. Also, making sure that you have the proper insurance. There is a lot of people who ask me, like, I don't need flood insurance. I'm not in a flood zone. But are you in an area where, like, for example, I live in Chicago, there's a lot of basement floodings because of the sewer system.
Tons.
So, it's very important for you to have that, that additional insurance to protect your biggest asset. Also, if you are in the Airbnb world, you want to make sure because in some policies, they don't cover any damage caused by your Airbnb tenants. So you want to make sure that you have a gap insurance to cover that just in case you do have to pull it for any of your Airbnb guests. So, those are some of the things. Also, you want to make sure that you have an additional liability insurance if you do have renters, because if they try to come after you and sue you, they're going to come after your entire assets, everything, unless you have it properly structured to the fact. And you should talk to, excuse me, a CPA or an attorney, because everything is
Both.
different in each state, yeah, or both, and just figure out how to properly structure your assets so they're not coming after you personally. And then there is the loss of income insurance. There is also, in case you have a tenant that is squatting in your, yeah, they're squatting. Let's call it what it is. They're in your property, not paying rent. You want to make sure that you do have some type of insurance to cover that rental gap. Now, I know I said a lot in there, but do you want to add anything as far as the insurance?
Yeah, I definitely the insurance part is huge. And I was looking at my insurance recently, like as in yesterday, and they automatically like increased a part of my coverage, and I didn't understand it. And my insurance went up, I think like $530 a year, right? So a couple things with that. So annually, when you closed on your loan, about a month before that following year comes up, check your insurance premium.
Yeah.
Most likely it went up. And this is your opportunity to find a new insurance company that may have a cheaper rate. Now, that's the one thing, Lourdes, that people will focus in on too much, in the sense that they like, well, I want the cheapest premium. You want the cheapest premium until you have an emergency
Right.
or an insurance related claim. And this is why you have to do the reviews, right? We're not insurance agents, we're not CPAs, we're not attorneys, but we own properties.
Right.
So this is something that we experience. And so, I talk to people that may have to do insurance claims, but the insurance company then doesn't want to pay out. While others are more, maybe I wouldn't say looser, but they're more of like, okay, this happened to your property. Let us get you squared away on that. So keep that in mind. And make sure that they explain the coverage you have. Do not rely on things like ChatGPT to be like, "Oh, please explain this to me," and then it gives you the wrong information, right?
For sure.
That happens all the time. If you look up like VA home loan stuff, you self disqualify yourself all the time. That's why we have the channel. Make sure you guys subscribe to VA Housing Education, hit the notification button, like the videos, comment, and share them, because the more information we get to the veteran community, the better they're off, or we are off, should I say. So, yeah, so just double checking that coverage and making sure you have the right amount. Is there such thing as over coverage? There can be, but that's why you really have to talk with a insurance professional and do your own research to find out where you stand. But yeah, that's a great topic on that, Laura. So thanks for talking about that. Um, what's the importance of having reserves when you own a property? Okay, so what reserves are, if you guys don't know, is there's not just the cost of buying a house, right? That's just step one. You have closing costs and you have your monthly payment. You have maintenance on a property, right? People, if you're buying a big asset, you want to protect that asset. Protecting it is maintaining it, right? So there's money costs with that. And if you're a renter or if you're a landlord, there's times where maybe tenants don't pay or you have a property that's vacant. Reserves is the money that you have set aside to help cover that. Lourdes.
Imperative to keep some money set aside.
Yep.
So, when I say, when it rains, it pours, like when something breaks, there's a chain reaction of other things breaking all at the same time. So I always have a rental reserve if you are using this as a rental, just to make sure that you have money to cover the mortgage and, just in case your tenants are not paying. And then two, a maintenance reserve. Put away some money every single year. When you first get an inspection on a property, they're going to tell you X, Y, and Z needs to be replaced in the next couple of years. Well, if it needs to be replaced within the next couple of years, start saving for it. So when it comes, you got it done. And then you have those things like the routine maintenance that you have to do. So it's very important to set aside those three buckets of funds so that you're prepared when you need it. Because I cannot tell you so many times people call me like, hey, this broke. I'm like, yeah, we knew about that. So, you said you had the funds to like fix that. So, go ahead and let's go ahead and, put that to it. So, especially when you do have renters, they don't take care of things as much as you do. So the life expense expectancy on those particular items don't really last you as long as if you were to have it.
Yeah. And that goes into like when you remodel a property, things that you need to consider when you're putting into it. But yeah, the reserve piece, I'll tell you that well, lenders, the way they look at it is they count 75% of rent roll. Like sometimes you can use that to qualify depending on the loan program. So there's some variations on that. So they expect a 25% vacancy rate, meaning that out of 12 months, for those months, they anticipate that you won't have a renter in there. Obviously, that's not what we hope for you, but this
Mhm.
is where pricing all of that into your rent is going to be such an important piece because Lourdes, if your rent, if your mortgage is 3,000, but your rent roll is going to be 3,100, I'm telling you right now, you are negative because you're not factoring everything in. And we did a whole video about
Mm.
that before. And it's kind of like looking at the debt service coverage ratio. Like, what are my actual monthly expenses? Now, the advantage you have if you live in the home right now is the cost of it, right? You know the average electrical cost, the gas bill, your trash, water bill. So you can put that into the pricing, but it'd be nice to know that before you invest in a home, you're going to rent or a multifamily property, because then you won't be upside down. And that's something, Loris, a lot of people miss when they're looking at properties. Now, one thing that I want to talk about is diversification of properties. Now, this one is somewhat challenging, especially if you are hey, I'm a veteran. This is where I live. Hey, I want to buy some properties. That's one part. Second part is, hey, I'm active duty. I'm PCSing across the country and I'm picking up properties everywhere I go, or at least that's what my goal is.
Mhm.
Um, but they also have different types of properties, right? You have residential properties, which are 1 to 4 unit. You could sprinkle in some commercial depending on the type of loan you're getting. And then you have like true commercial and like commercial loans, as in like five, six, seven, eight, 20 unit buildings, obviously all different price ranges, and you can buy them everywhere. What's kind of the thought process? I would say in a high level, because probably that's like a video on its own. What should someone consider and why when it comes to diversifying their portfolio if they're thinking about multiple home ownership?
Yeah, so I think really paying attention to the areas that you purchase in. So, for example, like, I mean, for anybody getting PCS, it's great because look at the area, there's a lot of people coming in and out, they're looking for rentals, etc. So that would be like a perfect ideal situation. But then I had one of my family members call me and was like, "Yeah, I'm thinking about moving to Florida, and I'm looking for something with a lot of great equity potential." And of course, we hear the rumor mill of like what's going on in
Right.
Florida, so we get tied to that. So I just say, make sure that you diversify your portfolio. Don't put all your eggs in one basket, especially like, if one area were to take a hit, at least you have others in different areas so you're not really, affected by all of that at one time. So, I think it's very important to diversify your portfolio and then also diversify your assets as well. So, focus a little bit on real estate. There's some people who do like flipping, there's people who and flipping, I mean, they take a property and it's distressed and then they fix it up and then they sell it. Other people fix it up, they keep it as rentals, and then other people just buy a rental property that's already fixed up. It's at the top of the market, but the rent rolls make enough sense for them to keep it that way. So definitely looking at different strategies. So if one place were to take a hit, then you're going to be okay with the other.
Right. And this is why when you're going to a new area, either you do the research yourself, which there's plenty of public data that you can do it on your own, or you get a professional to help you with that process. Right. So definitely a good piece on that. So thank you, Lordis. Right. Next, let's talk briefly about the legal compliance of being a landlord. That is, I know people personally that have PCS, active duty, and they've made mistakes when they rent to people. And I'll give you just an example. Like in some areas, if you collect a deposit, you have to pay them interest on there. And if you miss it, even if it's a couple pennies off, you could be significantly liable for that. And I had it to have it happen to someone I know over this. I think it was a very minimal amount. It ended up costing him $8,000 between them paying the tenant and in legal fees. So staying up to date on compliance and what's happening in your municipality, in your city, in your county, you're gonna have to be more involved than just a regular homeowner, I would say, for sure. What's your take on that?
Yeah, it's imperative. I like, one thing with the local zoning laws, I'll give you an example here in Chicago. They're going to start allowing more ADUs, which is additional dwelling units.
Yep.
So that's very important when you're looking at valuation, when you're looking at, what's going to go with that. So it's very important to follow up with that. I know in near the near a trail, it's called the 606 trail. All the now there's a special like, street by street type of thing where you can't evict a tenant, you can't, I mean, there's just like a whole lot if you're planning on selling, and if you wanna sell the property, they have the first, they can purchase it before anybody else can. So there's, like, so many, they have the right to anyways. So there's so many changes that happen just sporadically too, so it's very important for you to understand what those are so that you're in compliance with that. In addition to building codes, I think that that's very important too. They change all the time. And it just takes one tenant to say, to the city, like, hey, this is not done the way it's supposed to. I don't have to pay rent. Now you have the city on you. You have to do it correctly. And, you have fines that are coming about and accruing. So it's important for you to do that as well. Um, and then knowing the tenant landlord regulations, rights, what you can and can't do. And I know I live here in Chicago, so I'm very familiar with these things. And I'm also a landlord, so I apologize for referencing it so much. But they have a squatting, like you can't kick out, people who are squatting in your home. You have to go through the legal process, and it can take a year, 2 year. It can take such a long
Wow.
time. So if you don't hire like an attorney, it can be closer to that 2 year mark. Like they can stay there. You can keep going to court over and over, and they're living there for free. And one, they're destroying your place. Two, you still have to keep like, paying the water bill. You still have to do all these things. It's very unfortunate because you can't cut the water off or else you're going to be held liable. So anyways, like there's just so much that goes into that, and it happens. And now finally they're going to pass like, if you can't prove that you're legally supposed to be in that property, or if the seller or the landlord has rights to that home, then you can get kicked out immediately. So I'm glad they're finally going to pass that. But being up to date with those things are just for your knowledge, are very important.
Wow. Yeah, there's a lot to that. And still, it's okay to purchase investment properties after hearing all of that, right? Tons of people do it. It's okay. And one thing to note too with these changes that happen in an area, and we talked about with insurance, make sure you are tracking your real estate taxes. If you are not tracking that, they will sneak up on you, and then all of a sudden you see a 30% increase. I know that happened in the city. And all of a sudden, tons of people started defaulting because their mortgage payments change rapidly and they have to like account for the extra payments that they've made. And sometimes, depending on which county you're in the country, they will make their assessment year different, right?
Right.
So taxes could be quarterly, they could be once a year, twice a year. You got to know when those taxes are due, number one. And number two, you got to know when the adjustments happen. Like, is it the second installment? What year is there going to be the reassessment? Those are all important things that go into your rental strategy. Now, let's talk about the exit strategy, something that you need to think about when you're doing the home buying strategy in that. So, everyone says, Lordis, it's all about timing the market. Now, I wish I was an expert in this because I would probably be filthy rich knowing all that, right?
Mhm.
Because it's just like in 2008, even if you bought in 2008, today, you'd still be well ahead and have hundreds of thousands of money in your equity, depending on where you bought, right?
Mhm.
um, People that bought in 2000, let's say probably 10, 11, 12, 13, 14, really bought at the low. They have the most equity. And I talk to those people all the time. Like, yeah, we bought in 2011. We took the risk and now we're sitting on 400,000 in equity. Hey, we're thinking about moving. It opens up options. And that's tough to do, right? And there's a lot of fear mongering right now around, oh, the housing market's crashing. Well, what's happening is what people wanted, more inventory. So when you have more inventory, you're going to have a price adjustment, but also home values risen since COVID at a pretty rapid pace. So any real adjustment from my perspective right now that's happening, and Laura's give me your take on that, is somewhat artificial, right? And we're just seeing small increments, and it's driven market by market. And I did a video on the ICE Mortgage Monitor report, which accounts for 99% of the data that's out there for mortgages. And let's say, for example, in Chicago, home prices as of uh, June 20, 2025 went up like 4.5%. But if you look at, let's say, Denver, it's down 20%, or Florida overall is kind of somewhat down. That's why it's so important to understand your area and your situation.
Right.
Lourdes, take it away.
Yeah. So just kind of I mean, there's a few strategies. When going in, one thing I always ask my clients, especially if they're active duty or what have you, like, what is your exit strategy? Do you plan on, keeping this as a rental? And if they say yes, then I always recommend going kind of like on the lower end of their budget. So if they want to purchase another property somewhere, they don't have to use the zero down, they can still use the no down payment option if they have enough entitlement. So that's one of the things that we look at, and then also we want to make sure that whatever they time they come in, if that's a time that they're going to be leaving, we can time the market accordingly. So we want to look to see, what is it like? Is it an area where the summers are very, it's a super high turnover, et cetera? Are you going to be in a market where it's going to be multiple offers, et cetera? What repairs do you need to make to the property to bring it to, to that quick selling process? And, you know, kind of putting together a plan. I have another client that calls me and says, "Hey, I'm gonna, get some money soon, and my tax money back, and I want to make some improvements in the house. But before I go crazy, can you sit down with me and just let me know what's going to bring value to my property, just in case one day I had to sell?" So, actually, next week I'm meeting, over dinner. They're like, "I'll cook you dinner." I'm like, "Sure, no problem." That wasn't, whatever. But I'm gonna go meet with my client and kind of go over, and I told him break it into 3 buckets. What are your needs? What are your wants? And then needs, wants, and maintenance items. So they're gonna be in that bucket, and then we're just gonna plan accordingly as far as what would be the ones that are gonna get them the best bang for your buck. And I did tell him put money aside for reserves. I was all like, so do not spend all of that money on this property. We're gonna go through like he was like, yeah, I want to do some closet work. I'm like, no, that's not going to bring like, there's more cost effective methods that we can still like get what you want, but it's not spending all of that. So just knowing what enhancements are actually going to, bring value to your home, either as a rental or even equity potential.
Yeah, and we talked about it a little bit earlier, but this again just drives it home. You have maintenance of a property, and then you have improvements to a property, right?
Absolutely.
Maintenance doesn't really do as much. Hey, I got to replace the roof. I spent 20,000. Oh, I'm going to ask 20,000 more for the sale of my home. That's not how it works. Um, you need an HVAC system, right? You don't need it, but like it's recommended. You do need heating, by the way, for a VA loan. You don't need air conditioning for a VA loan.
Yeah.
So that's just some important to know. You need a heating source. So uh, you have to maintain the exterior of your property. Those are normal things. Improvements. What's a like example? Like having adding an addition, add square footage. Now you can ask more per square foot price. That
Conversion.
ADU unit you talked about also goes into this timing of the market. I cannot stress adding, let's just say you have a 3-unit building and it goes to a 4-unit building. That's not like a couple dollars, right? That's not a couple thousand. That's not a couple 10,000. That could be hundreds of thousands of dollars difference for it. So if you're ahead of the game and you're planning that, this is part of your timing strategy for that.
Yeah.
What are some other things that would add value to a home?
Yeah. So kitchens, bathrooms, are the biggest value adds. Even landscaping, the curb appeal, it's very inexpensive and it makes the biggest difference. People look up, they say, I want to, everything is nicely maintained outside. They're going to maintain it very well in the inside. So I think that that's imperative. And then, what does not bring value, and I see it done all the time, and this is something a conversation I had with my sister was she wants to get, spend $12,000 on her closet organizers. And I was like, that's not gonna get you, the most value for I mean, it looks really nice, don't get me wrong, but that's more of a want versus, an equity potential gain. So just, really identifying, like, this is what's gonna bring value. Another thing that, I didn't mention that you should look at is the recent sales in your area too. What do those homes look like? Because you can go crazy with all these like upgrades, but if your house, they're just going to look at it in 3 buckets, like brand new rehab, it's an um
Condition.
average condition or poor condition. So if it falls in like these buckets, they don't care if you spent all this money on this, you're not going to get it back. So it's very important for you to look to see what is going on with your neighbors. And it's very easy just to go on like, like a Redfin or Zillow, whatever, and just go through them and say, like, okay, these are the improvements that were done.
Wow.
It's too easy.
Yeah, and I want to touch base on the DIY, do it yourself method. Okay. I probably did, it's safe to say, over 24 hours of research on maintaining a lawn recently. Okay. And what drove me to that is that I have a property that I need to, the landscaping is just, it's horrible. Weeds are everywhere. It's a total disaster. And I reached out to someone to get a quote. I got 2 quotes. Uh, one was $10,000, and the other one was $26,000, and that's to basically like level, replace the grass, all that stuff that I thought had to be done. After doing a ton of research, for about $600 worth of equipment, and I bought like nicer things, I'm able to do the whole thing myself. And to your point, when you drive around and look at properties, think of that like the yard, right? You're like, oh, if that looks really nice, and then you have a average or above home on the interior, that just adds to that curb appeal. And you know why? Because people don't want to do it themselves. And if you're not handy, guess what? You need some new friends. Find some friends that are handy.
Yeah.
That's like through Lordis, I was able to meet some people that I can get guys to come in for the day and just pay them a flat fee and they'll just help me out and it speeds up the process. But there's plenty of people out there that are willing to help you with that process. So um, this both goes to maintaining a property and also for the timing the market because like if a summer's coming up and you know you want to do some improvements to add to that curb appeal and for little money have it more competitive, that's huge. So thank you, Lordis, for mentioning that. That's pretty big.
Yeah.
Another thing that people have questions on is that you're not necessarily like, hey, I have a property, I want to hold it, but how do I access equity in that property? Now, it works different if you own a property and you're keeping it and you're living in it as an owner occupied, a lot of options. If it's an investment property, you're limited on doing HELOCs. Now, what you can do, there's people out there that I've met, actually a former client of mine, they owned over 20 properties. Now, their strategy was a little bit different, Lourdes, and I think this was genius. They bought homes for 25 to 45,000 in rural areas. They put about 20 to 25,000 into them. Then they rented them out for like Section 8 housing. So they were cash flowing. It was ridiculous, right? So you're talking about 60,000 all in per property, and they were cash flowing like 1,000 a month in each one of them, right? The
Mhm.
mortgage payments were nothing, but they also built an insane amount of equity in their properties. So what they were able to do was something that we don't talk about is doing commercial loans, which is huge flexibility. Regular conventional government loans have a ton of restrictions. Commercial loans are kind of like the Wild West, I would say. And so you could do cross collateralized loans. Like, hey, let's put a loan on all 25 properties and just take a line of credit out and use it as you needed to build more wealth, right? So money makes money and you got to spend money to make money, right? That there's no golden ticket unless you win the lottery. Okay, that's different. Okay, then hit us up, let's work together on that. But like, there's it's hard. And if you own a VA loan, right, and it turns into an investment property, guess what? You can still do what's called an interest rate reduction refinance loan, even though it's an investment property at current market rates, which is insane because you can't do that with other loan products. So you have an advantage of using your VA loan. But again, depending on how you stack your benefits, it doesn't always make sense to use that VA home loan.
Mhm.
But that is one thing about accessing equity because I know it is a strategy, right?
Yeah.
And if you get caught that you need money, but you can't have access to money because you don't have the reserves, you could be put in a tough spot. I just recently talked to someone like that, that they weren't able to refinance their investment property to pull cash out because the situation didn't make sense. This is why you got to
Mhm.
talk to a CPA. We talked about it in our prior videos, talking to an accountant.
Yeah.
One of the big advantages of having a property, because we both own them, is doing expenses, but it ends up hurting you at the end if you're trying to own 10 or 20 properties. So just be careful with that when you go through that process. Anything to add to that?
No, I think you hit
Awesome.
everything
See, this
on
is what we're talking about.
that.
Um, one thing, Loris, I want to ask you about, and somebody recently, this has happened to somebody that's buying a home. They ended up saying, like, you know what,
Mhm.
I'm not ready to buy right now, but I want to talk to the seller about doing a lease to own. And what that means is that they want to lease the property for 12 months. They want to put themselves in a better financial position and then buy it from the landlord. What are your thoughts on that? And if you want to add to that?
Yeah, so with that, you typically lock in a certain rate that you're gonna purchase. The rents go to the rent, it doesn't go sometimes it doesn't go it depends on how it's written out, but sometimes they'll go towards the payment, other times it won't. So, there is a higher non-refundable fee that goes into that. I've seen one at $5,000 that was a non-refundable fee, and I'm like, "That's huge, that's a lot of money." So, definitely look at the contract specifically, because literally when I saw a rent to own contract, it made my stomach hurt so bad because the house, let me kind of give you this situation so people can be aware. It was a lease I've never seen before, not the traditional leases you have, and it was, okay, you're gonna be selling at this price, you have a year, etcetera. On there, it says that the buyer that the buyer is or the tenant is liable for all repairs, so you can't call the landlord, say, "Hey, the toilet's not working," type of thing. So they threw that in there, so they had to take care and maintain of the property because they're gonna be buying the property. The other thing that was in there that was very alarming was the $5,000, it was a fee that was supposed to go towards the down payment if you purchase the property, but if you don't purchase the property, then it's not refundable. So,
Wow.
that's where that kind of went in, and there was so many things wrong with the house that they couldn't call the landlord. It was, like, crazy, flooding in the basement, etcetera. It was, like, horrible experience for them, and when I looked at the terms, I was like, that's not, like, the most ideal situation. So if this is an option for you, I would definitely look at the contract and just make sure that it's feasible. If you do and you are liable for repairs, I would get a home inspection on that, even as a rent-own option, just so you can see and be aware of that these problems are gonna be your problems. So that is, there's not, like I said, a standard lease that's used, it's always made up, so definitely check that over.
Yeah, definitely. A lot of people get taken advantage of on that. Number one. Number two, you got to understand your financial picture, like the reality, not like, oh, I hope this is what's going to happen. And I mention that sincerely because we'll look at people's credit and we'll be like, hey, this is going to be a 2-year process, or guess what, we're really 7 years out, like for everything to kind of fall off and for you to get to where you need to be. Same thing with savings. Yeah, based on your income, spending habits. See, this is what we really need to be.
Yeah,
This is why budgeting is so important, and credit is important because the higher your credit, the cheaper the money. That's like you can't don't take out bills that you can't pay. That's essentially what credit is that managing your finances. That's why budgeting is so important with that piece.
yeah,
Just know what you're getting into because that could happen like what Lordis mentioned. You're up 5,000. They may inflate the price. And then now you're responsible for everything, but then you're using your own reserves that you need for someone else's home. But at the
right,
end of the day, you're not going to qualify at the time the year is up. Now they've doubled down, made more money, and now what? And sometimes what I've seen them do is they'll increase your rent, right? They'll do a deposit, they'll increase your rent like $500, and they'll tell you like, oh, we'll take $500 a month and use it towards the purchase of like as a credit for your home when you get it. And then you don't get the home and now you just paid them a bunch of extra money. So again, these are just tactics. Be very careful with it. I've seen
mhm,
successes. I've also seen like what Lourdes just mentioned, huge downsides to it.
yeah.
All right. When it comes to holding a property long term, right? Because sometimes your strategy for a home may just be, hey, I don't want to sell it for 20 years. What's some of the pros and cons to that?
Yeah, so, there's a lot of pros to holding it. So,
So there can be cons, right? If a market
yeah.
shifts.
Yeah,
So
so some of the yeah, there can be some cons. Taxes can increase, insurance can increase. If it's a condo, you can have a special assessment coming up. So yeah, those are the positives. The negatives. The positives is cash flow. Like that is like huge. And for example, I have a client of mine, they have a property and it was their very first property and there's a lot of maintenance that's coming up to it. So they're like, you know what, I'm just tired of the maintenance. So I rather just take the equity and and run with it. And then I have another one that wants to sell it for super cheap. And I'm all like, your cash flow on this is over like $1,000. Like I wouldn't let this go. What's wrong with you? Type of thing. Like, you're cash flowing so much and you don't have to put any money into it. So definitely look at both of those options. And they can't even sell it for that much because it is a condo. Actually, that one is a condo. and I don't know, there's a lot of drama happening with the association, so they would have to sell it to a cash investor at a
Oh wow.
way discount price, but anyways, they're cash flowing like crazy. And then the bigger part of that too is the market appreciation. I'll give a quick example of, there was an option, when one of my first properties that I purchased was in Seattle, and I was told by a lender that we needed to sell it, and we used my entitlement. It was a horrible experience. Everything went wrong with that transaction, and we had to
Before we
sell that
met.
home.
That's before we met,
That
so
was
everybody
before. That's
knows.
why I started working with David, because at least you educated me. You told me, like, "Yes, you can do these things." He said we had to get rid of it, and my entitlement didn't even go on the new property. So,
Right.
in reality, we didn't have to do that. We coulda just got, my ex off of the mortgage, and then I could have kept that, and he would have been free and clear, and then he could have, whatever. And, the equity potential that we lost, because my intention was to keep it as a rental, but I was told we couldn't. But the equity potential that we lost, was about $400,000 had I sold it when I purchased this one. So, that's $400,000. That's massive. That's huge.
Right.
So, it goes to show that, depending on an area, is the market appreciating and at what rate? So, pay attention to that.
Yeah. No, that's huge. I know we talk about that like once a month at least.
I know.
It's okay. I passed up properties that I went. I'm like, I cannot believe I passed that up. The
Yeah.
potential, but also that's one. One thing that we didn't plan to talk about was FOMO, fear of missing out. Okay,
Yes.
don't fall into these traps. Right. Uh, but I say that sometimes to my son. I'm like, he doesn't want to eat his food. I'm like, everyone's eating it, but you. Okay, so that's a different scenario. Okay, but in when it comes to the rental game, you don't want to be like, well, my buddies are all doing it and there's finding success, because it may not be the thing for you, right? You really need to understand where you're comfortable with the risk and understanding the process. So when it comes to investing, there's a lot that goes behind it. Last thing I want to talk about is financing options. Now, this goes both for buying a property and if you're selling a property for a potential purchaser. And that's going to be, and you guys may not know this, but they're what's called seller financing option. I bring this up all the time, and people are like, "What?" I don't even know what that is. And so basically, what it is that let's say Lordis comes and wants to buy my property, and I don't have a mortgage on it, or I have a mortgage on the property, or whatever the case may be. You can act well. Typically, it works when you don't have a mortgage on it, but I can give Lordis a loan, like a real mortgage loan, on my own. Attorney drafts up the contracts, and then she pays me on a monthly basis for the payment, right? So it's possible to do that, and I do see that in some listings where they're like owner financing is available. So that may open up for folks that may not qualify because of their self-employed income, because we see that a lot, right? That's why you have those bank statement loans. um but that might open up a pool for you to become a homeowner, both from a buy side and then from a sell side, to be able to offload your property. Now, just be careful, okay? Because normally the irony of the situation is you may have to do a large down payment. You start missing payments. The person that sold it to you, that made money on you, now forecloses on you and gets their whole home back. That's ironic, but it does happen. But Lourdes, what is your take on that?
On the owner financing?
Yeah,
Um, I just make sure that it is seen by an attorney and that everything is, like, legit. But I look into seller financing options if at all possible, because it doesn't, do anything on my credit. I've even offered, like, my neighbor, I was like, "I'll do I'll buy with seller financing," and giving them that option, because I really love the area. So yeah, I think it's a great way. It's also a great way to attract buyers too, because if you're having a problem like selling the property, that seller financing option can go a long way. It's just going to open up more of a pool of buyers. So that is another great way to get what you want out of the property, and then also get it sold.
that's awesome. Well, thank you for that. Anything else to Lourdes to add for this series?
Well, I did want to kind of just briefly touch on the 1031 exchange. Just,
And by the way, we're not attorneys, CPAs, or anything. This is Laura's talking from her own experience.
yeah. So if you do end up selling your property and you have, and you don't, you have an excess of equity potential, then there, and you want to acquire more real estate properties. So if you currently have a rental and you want to buy some more rentals, then you can use that 1031 exchange. It just has to be similar. So commercial property has to be commercial property, a building has to be a building, etc. So you can roll that in, and there's different time periods that you have to meet. You have to be under contract within a certain amount of days. And the reason I'm not saying the specific days because it changes a lot. So and under you have to be under contract, and then you have to close within a certain amount of other days. So for that asset, so double check to see what it is, and yeah, so pay attention to the rules on that. But it's a great way to limit the liability of capital gains tax that you actually have to pay.
That's awesome. But yeah, talk to a CPA because that changes all the time and recently it changed as well. So thanks for sticking with us throughout the whole video. Make sure you hit the like and subscribe button. Drop a comment down below. Let us know what you think of the video, as well as any other videos you guys would like for us to do. And we'll catch you guys soon.